You were taught that modern finance is stable, that markets self-correct, that reserve currencies decline slowly, politely, over decades. You assume that collapse looks like chaos first, and balance sheets second, that if something were truly wrong, bond markets would scream, currencies would panic, capital would run. But history doesn't work that way, and neither do financial systems. You think empires fall because they lose wars, because of bad leaders, because of external shocks. That belief is comforting. It implies control. The uncomfortable truth is this: most empires collapse while they still look powerful, while markets function, while debt is refinanced, while the currency still buys groceries. The danger isn't volatility, it's normalcy. Because financial systems don't fail when people are afraid. They fail when incentives quietly stop working, and no one wants to admit it. That's the part you were never taught. The story you were taught about financial power. You were taught that financial power is visible, that it shows up in numbers you can point to. GDP size, stock market capitalization, military spending, currency dominance. If those numbers are large, the system must be strong. If markets are calm, the structure must be sound. If investors keep buying government debt, confidence must be justified. This story feels rational because it mirrors how markets behave day to day. Prices move, rates adjust, capital reallocates. And as long as that machinery keeps functioning, it creates the impression that stability and sustainability are the same thing. They're not. Financial systems are very good at maintaining appearances long after the underlying logic has changed. In fact, the more sophisticated the system, the longer it can operate in a state of quiet contradiction. You were also taught that collapse announces itself, that warning signs come first, that panic leads the process, that markets are early detectors of danger. But markets don't price long-term sustainability. They price short-term liquidity and credibility. As long as obligations can be rolled forward, as long as payments clear, as long as confidence hasn't broken, the system looks functional. This is where the misunderstanding begins, because financial dominance is not the same as financial health, and scale is not the same as resilience. Large empires don't fail because they suddenly lose access to money. They fail because money stops doing the work it used to do. Capital stops building capacity and starts maintaining appearances. Debt stops funding growth and starts funding continuity. At that point, the numbers still look impressive, but the direction has already changed. Another belief, quietly reinforced, is that strength is self-correcting. If something becomes inefficient, markets will fix it. If spending becomes excessive, discipline will return. If debt grows too large, incentives will force reform. That logic works for individual firms. It does not work for dominant financial systems. Because dominant systems don't face external discipline early. They export it. They borrow cheaply because they are trusted. They run deficits because others need their currency. They extend commitments because financing is always available. What looks like flexibility is often insulation from feedback. And insulation delays adjustment. So when people look at powerful empires and say, nothing is broken, markets are functioning, they're often looking at the wrong layer of the system. Functioning plumbing doesn't mean the structure is sound. It just means the pipes haven't burst yet. The uncomfortable truth is that most financial collapses begin when everything still works, not when confidence disappears, but when incentives quietly invert. And by the time that inversion becomes visible, the outcome is no longer a decision. It's a process. Why reserve currencies don't create power? They absorb risk. You were taught that issuing the world's reserve currency is the ultimate financial advantage, that it lowers borrowing costs, that it attracts capital, that it gives governments flexibility no one else has. And all of that is true, at first. What's rarely discussed is what reserve currency status actually does to a balance sheet over time. A reserve currency is not held because it is productive. It is held because it is liquid. Global trade needs a medium that clears transactions smoothly, predictably, and at scale. The reserve currency exists to absorb friction, not to generate value. That distinction matters. Because when the world demands your currency, it doesn't pay you with goods. It pays you with claims. Foreign governments accumulate reserves. Central banks recycle surpluses. Global savings flow into your debt markets. On the surface, this looks like strength. Capital inflows push interest rates down. Asset prices rise. Deficits feel painless. But what's actually happening is risk transfer. The global system offloads volatility, imbalance, and adjustment costs onto the reserve issuer's balance sheet. Trade deficits don't force correction. They accumulate. Fiscal excess doesn't trigger discipline. It's financed. Currency debasement doesn't cause capital flight. It's absorbed. This creates a dangerous illusion. That demand equals confidence. In reality, demand for a reserve currency often exists despite declining fundamentals, not because of them. As long as there is no alternative system capable of handling global scale, capital keeps flowing in, not because the system is healthy, but because it is necessary. That necessity delays consequences, but it also changes incentives. When issuing debt is easier than producing value, when consumption is cheaper than investment, when financial assets outperform real output, capital reallocates accordingly. Over time, the reserve issuer stops exporting goods and starts exporting paper. Claims on future production replace present output. This is the moment where reserve status quietly turns from privilege into liability, because every surplus held abroad represents future purchasing power that can return home. Every foreign reserve is a deferred claim. As long as confidence holds, those claims remain dormant. They sit quietly on balance sheets. But if confidence shifts, even slightly, they don't disappear. They come back. And when they do, the adjustment is not gradual. It shows up as inflation, currency pressure, and political stress all at once. Reserve currencies don't collapse because people stop using them overnight. They collapse because the cost of maintaining them exceeds the benefits. And by the time that realization spreads, the system is already constrained. Power didn't disappear, it inverted. Overextension isn't a military problem, it's a balance sheet problem. You were taught that military overreach is a strategic failure, that empires collapse because they fight too many wars in too many places for too long, that generals make bad decisions, that politicians miscalculate, that framing is incomplete. Military overextension is not primarily a tactical mistake, it is a financial condition. Empires don't deploy globally because they enjoy it. They do it because global reach once produced net returns. Trade routes were protected, resources were secured, currency demand was reinforced. As long as expansion increased productive capacity, the balance sheet improved. The problem begins when expansion becomes maintenance. Global commitments are fixed costs. Bases must be staffed. Alliances must be honored. Credibility must be defended regardless of return. At that stage, military power stops generating surplus and starts consuming it. But debt masks this transition. Borrowing allows an empire to fund obligations without raising taxes. It postpones political resistance. It preserves the illusion of affordability. This is where the system quietly breaks. Because debt does not eliminate constraint, it delays it. And delay compounds cost. Every year, commitments are rolled forward, liabilities grow faster than productive output, interest becomes non-negotiable, flexibility disappears. What looks like strength, global reach, deterrence, presence, is actually leverage. And leverage behaves well only until it doesn't. The real danger of overextension isn't losing a war. It's losing the ability to choose which obligations matter. At that point, the balance sheet dictates strategy, not the other way around. The moment productivity stops paying the bills. You were taught that large economies are resilient by default. That size itself creates stability. That complexity equals strength. You were told that innovation will always emerge when needed. That capital naturally finds productive uses. That scale guarantees adaptation. This belief holds true, but only under one condition. Capital must be rewarded for building capacity. As long as returns come from producing goods, improving systems, and expanding real output, the economy renews itself. Factories modernize. Skills compound. Infrastructure evolves. But every dominant financial system eventually reaches a point where that incentive quietly changes. Not because leaders decide it should, not because productivity suddenly fails, but because financial returns diverge from physical reality. When issuing claims becomes more profitable than producing goods, when asset appreciation outpaces real investment, when financial engineering delivers higher returns than building, maintaining, and expanding productive capacity, capital follows the signal. It always does. Factories don't close because people forget how to build. They close because returns are inferior. Supply chains hollow out not due to incompetence, but because efficiency is measured financially, not strategically. A factory that provides resilience but lowers margins is inefficient. A supply chain that reduces geopolitical risk but raises costs is uncompetitive. In spreadsheets, resilience looks like waste. So capital reallocates, not out of malice, out of logic. The economy continues to grow, at least on paper. GDP expands. Markets rise. Balance sheets look healthy. But the growth is internal. Assets trade hands. Debt refinances debt. Consumption is funded by future claims. Very little of it expands real capacity. This is the exact moment productivity stops paying the bills. From this point forward, the system no longer advances by creating more. It survives by rolling promises forward. Old obligations are met with new credit. Growth depends on refinancing conditions, stability depends on sentiment, and rolling promises requires one thing above all else: credibility. As long as the currency is trusted, claims are accepted. As long as claims are accepted, production can be deferred. As long as production is deferred, the illusion of stability holds, but production cannot be deferred forever. You can import what you no longer make. You can financialize what you no longer build. You can monetize future labor that hasn't happened yet. But eventually, the system becomes dependent on continuous inflows of confidence, not output. And confidence is not a resource. It cannot be mined. It cannot be manufactured. It cannot be compelled. It is a condition. Once capital realizes it is financing maintenance instead of expansion, behavior changes. Quietly at first. Investments shorten their time horizons. Risk tolerance shrinks. Liquidity becomes more valuable than productivity. Capital stops asking, "What will this build?" and starts asking, "Can I exit quickly?" At that point, fragility increases even as prices rise. Then, when confidence finally hesitates, not collapses, just hesitates, everything that depended on rolling forward begins to strain at once. That's why financial systems don't fail when productivity disappears. They fail when confidence realizes it was compensating for productivity all along. And by the time that realization spreads, the transition back is no longer possible. Why collapse feels sudden, but is never unexpected. You were taught that collapse is caused by shocks, a crisis, a war, a market crash, a policy mistake. In reality, shocks are triggers, not causes. By the time collapse feels sudden, the system has already lost its margin for error. The reason late-stage systems appear stable is because everyone involved is incentivized to maintain continuity. Politicians defer reform because adjustment is painful. Markets assume support because it has always arrived. Institutions protect credibility because losing it is fatal. This creates lock-in. The cost of change becomes higher than the cost of delay until delay becomes impossible. At that point, credibility doesn't erode gradually. It reprices. Debt that was assumed rollable becomes questionable. Currency demand that was assumed structural becomes conditional. All at once. Collapse feels fast because belief changes faster than capital can move. And once belief shifts, leverage works in reverse. Systems built to absorb stress amplify it. This is why late-stage empires don't decline gently. They gap lower. Not because people didn't see it coming, but because no one could afford to act early. Why history keeps repeating this pattern. You were taught that intelligence prevents failure, that better data, better models, better institutions change outcomes. History suggests otherwise. Empires don't collapse because they lack information. They collapse because information conflicts with incentives. Every dominant system believes it can outgrow its constraints. That it can borrow a little longer, spend a little more, adjust later. And for a long time, it's right. That's what makes the pattern dangerous. The system works until it doesn't. Not because it was foolish, but because it was rational within its incentive structure. This is why history repeats. Not because leaders are ignorant, but because power resists admitting limits. The pattern is not destiny. But it is pressure, and pressure doesn't ask for belief. It asks for balance. Whether systems adapt in time is always uncertain. Timing is unknowable. What history shows, repeatedly, is that dominance carries the seeds of fragility, not through weakness, through success. And that is the part that makes collapse so hard to see, until it's already underway. So where does this leave us? History doesn't repeat, but it rhymes with uncomfortable precision. Empires don't collapse because people see it coming. They collapse because the system becomes too complex, too fragile, and too dependent on belief. And belief is the only thing that can't be printed. The question isn't whether systems fail. They always do. The question is whether individuals recognize the pattern before the costs are passed down to them. Because by the time collapse becomes obvious, choices disappear. History doesn't warn loudly. It whispers to those willing to listen. And the most dangerous assumption you can make is believing that this time is different.